You've probably heard that investing in stocks can make you money, but how does that actually work? It's more than just buying low and hoping to sell high. From collecting steady dividend payments to actively trading for short-term gains, the stock market offers multiple paths to real income. But each comes with its own strategy, risks, and rewards. In this video, we'll break down how people turn stocks into cash-flowing assets, whether you're a beginner looking for passive returns or someone ready to dive into day trading. If you want your money to start working for you, this is where it begins. Today, we will talk about how to make income from stocks, dividends, trading, and more. So before we get started, make sure to hit that like button. Also subscribe to my channel. Dividends, the easiest way to earn while doing nothing. Dividends are probably the most popular way to earn passive income from stocks. When you buy shares of certain companies, those companies share part of their profits with shareholders. This payment is called a dividend, and it's usually given out every quarter, 4 times a year. Imagine owning shares in a company like Coca-Cola. Every time they pay dividends, you receive money just for holding their stock. The more shares you own, the more income you get. And if you reinvest those dividends, your earnings can snowball over time. You don't have to be rich to start earning dividend income. Many dividend-paying stocks are available for less than $50 a share. The key is consistency. Buy a few shares each month, focus on companies with strong histories of dividend growth, and hold for the long term. Over time, you'll start building a steady stream of income that doesn't depend on your job. REITs, earning from real estate without buying property. Real estate investment trusts, or REITs, are companies that own or finance income-producing real estate. When you buy shares of a REIT, you're essentially investing in properties like shopping centers, apartments, or office buildings. REITs are required by law to pay out at least 90% of their income to shareholders as dividends. That means they often have higher dividend yields compared to regular stocks. Some REITs pay 4%, 6%, or even 8% annually. The best part is you don't need thousands of dollars to get started. Many REITs trade like normal stocks, and you can start small while still earning monthly or quarterly income. It's a smart way to benefit from real estate without dealing with tenants or maintenance. Index funds and ETFs, safe and steady income. Not all stock market income is about fast gains or high-risk trades. Index funds and ETFs, exchange-traded funds, are great tools for steady, long-term income. Some ETFs are designed specifically for income. They hold a collection of dividend-paying stocks and distribute the dividends to investors. This way, you get broad market exposure, reduced risk, and consistent payouts, all in one. For example, an ETF like VYM, Vanguard High Dividend Yield, gives investors access to a range of strong dividend-paying companies. It's a simple way to diversify and build a base of income without picking individual stocks. ETFs can also be bought and sold like regular stocks, making them a flexible and beginner-friendly option. With regular contributions, you can grow your portfolio and increase your income over time. Covered calls, making money on stocks you already own. If you already own shares of a company, there's another way to earn income: by writing covered calls. This is a more advanced strategy, but can be very effective. Here's how it works. You sell someone else the option to buy your shares at a set price within a certain time frame. In return, you get paid a fee, known as a premium. If the stock doesn't reach that price, you keep the premium and your shares. Many investors use this strategy to generate monthly income from stocks they already plan to hold. Platforms like Robinhood and Fidelity allow users to set up covered calls fairly easily, but it's important to understand the risks and learn the strategy before diving in. Swing trading, quick profits with a plan. Swing trading involves buying and holding a stock for a few days to a few weeks, aiming to profit from short-term price movements. Unlike day trading, it doesn't require you to sit in front of a screen all day. Swing traders use charts and trends to decide when to buy and sell. It's not gambling. It's a skill that improves with education and experience. To succeed with swing trading, you need discipline, a strategy, and a basic understanding of technical analysis. While it can be risky, many people use it to supplement their regular income or grow their accounts faster. It's best to practice with a demo account first or start small. Don't risk money you can't afford to lose. But once you understand the process, it can become a reliable income stream. Dividend growth investing. Bigger payouts every year. This strategy focuses on companies that not only pay dividends but increase them over time. These are businesses with a solid track record of boosting shareholder rewards every year. Think of companies like Johnson & Johnson or Procter & Gamble. They've raised dividends for decades. That means your income keeps growing without you buying more shares. If you invest early and consistently reinvest your dividends, you can build a powerful income machine. 10 years from now, you could be earning double or triple the amount you started with, just by holding the same stocks. Dividend growth investing is great for long-term planners. It rewards patience and can provide peace of mind during market downturns. Fractional shares. Start small. Think big. You don't need hundreds of dollars to buy stock in companies like Apple, Amazon, or Google. Thanks to fractional shares, you can invest with just $1. This opens the door for beginners to start earning income, even with limited funds. Apps like Robinhood, Fidelity, and M1 Finance allow you to buy fractions of a share and still earn dividends. Over time, those small investments add up. The key is consistency. Set a goal to invest a small amount weekly or monthly and watch your income grow. Fractional shares also help you diversify. You can spread $100 across 10 different companies instead of buying a single expensive stock. DRIP, reinvesting for faster growth. The Dividend Reinvestment Plan, DRIP, is a powerful way to grow your stock income faster. Instead of taking your dividends in cash, you use them to automatically buy more shares. Many brokerages offer this for free. Over time, this snowballs your holdings and increases your future payouts. It's a passive, disciplined approach that rewards long-term thinking. This strategy is ideal for people who don't need the income right away and want to maximize growth. The compounding effect can lead to surprising results in just a few years. Important tips for stock income success. Don't chase high yields. Some stocks offer 10% plus dividends, but are not financially healthy. Focus on stability and reliability. Diversify your income streams. Don't rely on just one method. Mix dividends, ETFs, and maybe some trading for balance. Be patient. Building stock income takes time. Stick to your plan and let compounding do the work. Stay informed. Read company earnings reports, watch financial news, and keep learning. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.